Hello, my name is Steve Richard and I'm President and CEO at Teachers Plus Credit Union. At Teachers Plus, our business is banking and honest financial advice where you want, when you want. We support our members and the communities we serve. Our largest community is the community of teachers in Nova Scotia. We have members from every county in Nova Scotia. Because Teachers Plus was started in 1954 by teachers for teachers, we've continued to focus our business on satisfying the needs of teachers. You can get all the products and services your bank currently offers, such as RRSPs, TFSAs, loans and mortgages, online banking and mobile banking, and more. But we also have products designed specifically for teachers. These include Master's Upgrade line of credit, 5-year free service charge packages for new teachers, pension buyback loans, and a strike policy where all your loan and mortgage payments are deferred during a work stoppage. We also provide financial education seminars by way of pre-retirement sessions and budgeting sessions throughout the province. More recently, we have received numerous calls from teachers looking for information about taking their service award early. So we put together a seminar and this presentation to try to provide teachers with as much information as we can to help you through your decision. We hope this is helpful. But if you have any additional questions, please call us at the credit union and we would be happy to answer any individual questions you may have.
The following information is solely the opinion of Teachers Plus Credit Union, based on the information available to us to date. We are in no way providing direction on whether you should accept or not accept your service award early or at retirement. We are simply providing information to assist you with the decision. I'd now like to introduce Dale Rood, Manager of Financial Services, who will walk you through the presentation.
For this presentation, we'll be going through the following things: your early service payout options and options that are not available. Your service payout will be paid to you as employment income, some of the ramifications of it coming to you as employment income. Looking at the decision whether to leave the service award to be paid out as a regular service award or taking it and investing it. The pros and cons of accepting the offer, and using the offer to pay off debt versus investing the funds. You've all received your early service payout letter by now. You have 4 options. You can accept the early service payout as taxable income, and it will be paid to you this summer of 2018. You can accept the early service payout and roll the entire amount of the early service payout into an RRSP. You can do a combination of 1 and 2, accept some as cash and roll the remainder into an RRSP, or you can not accept the service award, the early service payout offer, and wait to take it as a regular service award, which will be paid at retirement. Options that are not available to you with this early service payout offer is to take part from the early service payout offer now and take the remainder as your regular service award when you retire. It's an all or nothing option. You also cannot delay your decision until after March 19th of 2018. If you make no decision between now and March 19th, you'll opt into declining the offer and accepting the funds as a regular service award. The early service payout will be paid to you as employment income. It's going to be based on your income as of March 31st, 2018, and based on your years of service prior to July 31st, 2015. The payment is not considered salary, so it will not be subject to pension deduction. It will not count towards additional pensionable service, and it will not count as income used when calculating the highest 5 years of your income for pension purposes. Some of the possible impacts from this early service offer coming to you as employment income is the effect that it may have on income tested benefits, as well as making your income tax payable this year higher than usual. Because you're taking this as employment income, it could potentially increase your taxes for this year, the overall income tax that you pay. It also may have an impact on receiving the Canada Child Benefit, which is an income tested benefit. CPP disability and private disability payments may also be affected. Those you should check with them directly on that. EI, maternity or parental leave benefits may be affected since they are also income tested benefits. Support payments and maintenance enforcement, if you currently pay those, they are usually income tested as well. Future obligations in a separation or divorce agreement with respect to your service award may be impacted by this, and you should check with your lawyer on that. And any other income tested obligation or benefit may be affected. For income tested benefits, they can be affected by this increase in your income for 2018 if you accept the early offer. Rolling your funds into an RSP, which is one of the options to you for this early service payout, may not affect your income tested benefits, since these benefits are often based on net income, which is line 236 of your income tax return. However, there are some benefits that are affected by line 101, 104, or 150 on your tax return, such as EI, so potentially maternity and parental leave as well, and CPP disability. It's good to check on these things to make sure that you won't be affected by accepting this offer. As well, child support may be affected, since maintenance enforcement looks at line 150 when deciding how much is payable by a parent. If your service award also is the subject of a separation agreement where you potentially have an obligation to your former partner, then you should consult your lawyer to check on how accepting this early payout offer may affect that part of the contract. There are some potential tax implications, obviously, from taking the early service offer that you've been presented with. The income, first of all, from your early service payout, if it's taken as cash, will most likely be taxed at the highest marginal tax rate, which is somewhere between 50 and 54%, and that will be deducted at source when you receive the funds in the summer of 2018. Although some of this tax deduction will be refunded back to you when you file your income taxes in the spring of 2019, it will still increase your overall personal income tax liability for 2018. One of the things that we wanted to take a look at is leaving the investment to take it as a service award at a later point, or taking the early payout offer and investing it yourself, and what sort of returns you could look at. We use some assumptions in going through this. If you leave it in the hands of the province and get it paid as a regular retirement service award, we factored in that you would be receiving wage increases or salary increases approximately equal to what the cost of living has been over the last 20 years. So we were looking at approximately 1.81%. We compared that with taking the early service payout offer now and investing it either in a 5-year GIC or in the stock market. Looking at the returns on 5-year GICs over the last 20 years, they've been averaging approximately 2.6% for an investment return. The TSX Composite has averaged approximately 5.88% over the last 20 years. Of course, one thing to factor in investing in the market is that when you do that, your risk is much higher than either of the first options of either waiting for the regular service award or investing in a term deposit. So looking at the chart, here's a comparison of the three options from the previous slide. The blue line shows leaving the retirement service award in place and the potential for wage growth over 20 years. The orange line shows the potential return for investing the money into a term deposit or GIC. The gray line shows the TSX market growth over the past 20 years. As you can see, there's lots of volatility with that return. Although it is higher, you would certainly have to have the stomach to weather the ups and downs of the volatility of the market. And depending on your investment horizon, you may want to consider a safer option. So we'd like to take a look at the pros and cons of accepting the offer and investing the funds versus leaving it in the hands of the government right now and taking it as a retirement service award when you retire. So the pros of accepting the offer and investing the money is that you will potentially get greater growth over wage growth, which we've looked at as a consumer price index, the equivalent of that. It will be in your hands now instead of with the province, and you can use the funds if you do take them now and invest them in an RSP, either for a first-time home buyer plan if you're looking at purchasing a home in the next few years, or potentially as well for maternity leave pension buyback. Some of the cons in taking it now is that if your income increases substantially between now and retirement, you may not benefit from that wage increase. Those increases could be from regular wage growth. They can also be from salary upgrades or license upgrades, or also from taking administrative positions. As well, taking the funds now as opposed to leaving them and taking them as a retirement service award means you will not have any eligible amount when you take them now. What an eligible amount is, basically it keeps you from having to use your own personal RRSP contribution room at that time. If you take the funds now as opposed to leaving them for the regular service award, you may not be able to roll the funds fully into an RRSP. You may not have the personal contribution room, so you may want to wait for that reason. And as well, taking the funds now, they will be subject to EI and CPB deductions, whereas a regular service award is not. One of the other questions that we've been getting from teachers on accepting the early service payout is the benefit of taking it now and paying off debt versus either taking it and investing or leaving it as a regular service award. We wanted to take a look at the pros and cons of paying off debt versus investing. So one of the factors that you have to take into consideration if you're going to take it as cash and pay out debt now is that you're going to be taxed at a very high income tax rate, probably around 54%. We looked at a scenario where if you're receiving an early service payout offer of around $20,000, taxed at the highest tax rate, you're going to lose approximately $10,800 off of that $20,000 if you take it as cash. You will receive some back when you get your refund, when you file your income taxes in spring of 2019, but your overall income tax liability will be higher. If you take it as cash now, you're also going to lose the value of compounded growth versus investing the funds. And as well, as a retirement service award, this early payout offer is really meant to supplement your income through retirement. So you may not have that same benefit when you retire if you take it as cash now and pay out your debts. Let's look at a scenario where you currently have a $10,000 credit card with a 19.99% interest rate. Your options in taking this early payout offer are you can either take the full $20,000 early service payout offer and roll it into an investment and pay off the credit card. It would take $265 monthly, and that would pay the credit card off in 5 years. Your other option is to take the early service payout of $20,000. You would lose approximately 50% to income tax deduction, but then you could take the $10,000, pay off the credit card, and use that $265 that you were going to be paying on the credit card to reinvest into an investment for the future. For this scenario, we used some basic information looking at the 2.6% historical GIC interest rate over the past 20 years. And as you can see, by comparison, if you take the $20,000 and roll it into your RRSP, and the growth happens over the next 5 years, total amount you'll have in 2023 in your investment is $22,724.13. By comparison, if you take the $10,000 after tax and pay off your credit card, and then contribute $265 monthly over the next 5 years, at the end of 5 years, you'll have approximately $16,960.19. You can see that there's a difference between those two of about $5,700, and although the funds will be in an RSP with option number 1, and they will be after tax with option number 2, you will still be further ahead with compounding interest to have invested the money. So the pros and cons of paying debt versus investing the funds if you decide to take the early service payout offer. The pros of paying out debt is that the debt will be eliminated and it will provide you with more cash flow. You won't have that payment to make, and it will also decrease your debt servicing ratios. So if you're looking to qualify for a mortgage or for other debt in the future, it's going to make it easier to qualify. The cons are that you will have higher income tax for 2018 because the funds will come to you as taxable income. You're going to have lower net worth after 5 years, as shown in the previous slides, since you won't have the value of the compounding investment, and you potentially will also have the loss of the financial cushion that the service award is supposed to provide at retirement. Here's your timeline for accepting the offer. You have to have your decision by March 19, 2018, and in making your decision you have to complete and submit the election form as well as the declaration of intent. The declaration of intent has to be completed and sent in regardless of whether you're rolling under $15,000 or over $15,000 into an RRSP. Through the spring of 2018, and really as soon as possible after you make your decision, if applicable, you have to complete the T1213 and send it to CRA for approval. Once that's been received back, that approved T1213 has to be sent into the board. In summer of 2018, you will receive the early service payout. It will be deposited into your checking account where your direct deposit goes now for your regular salary. It will be deposited potentially less income taxes, and definitely less CPP and EI, as well as any other deductions that may be taken from it. If rolling the early service payout into an RRSP, after you receive your early service payout in the summer of 2018, you should visit your financial institution to make your RRSP contribution. Lastly, one of the very critical considerations that we wanted to present to you is that the RRSP deposit that you make in the summer of 2018 has to match the amount that you're declaring on your declaration of intent. Understand that CPP and EI will be deducted from any amount that you receive from the board, and if it is less than what you've declared on your declaration, then you will have to make up the difference yourself. Failing to ensure the deposit matches the declaration could potentially create serious penalties from CRA, so it's very important to do that.
Okay, thanks Dale, that's great information. We are now going to open the presentation up to questions which we have received from teachers over the past couple of weeks.
Do we have any information on whether the service award will still be there if teachers decide to wait until retirement to take it?
We have no more information than teachers do right now, so we wouldn't be able to comment on the future potential of the service award being available.
Have we ever seen this situation before where service awards are provided to people prior to retirement?
We have not seen this situation before, and we are not aware of any circumstances where it has arisen.
So are teachers limited to $15,000 transferred to an RRSP, or can we put the entire amount in? Do you have to have the RRSP room available?
Teachers aren't limited to just transferring $15,000 into an RRSP. However, you do have to have personal contribution room for the full amount you want to transfer to an RRSP. The personal contribution room can be found on your notice of assessment, which is sent to you after you file your taxes.
Just to confirm, if you elect to transfer more than $15,000, you still have to complete both forms?
If you elect to transfer more than $15,000 to your RRSP, you do have to complete both the declaration of intent and the T1213 for making that transfer happen.
If your service award is under $15,000, do you only need to fill out the $15,000 declaration form?
If your service award is under $15,000, you only need to complete the declaration of intent.
Can you contribute your service award to a spousal RRSP if your spouse makes less than you or doesn't have a pension?
Thanks, Dale. I can take this one. So information in the documents provided to you with your service award package from the NSTU indicate that you can use a spousal RRSP to make your contribution. However, it's very important that you remember that you must have the RRSP room yourself, regardless of the fact that you are investing in your spousal RRSP.
Can you have your award transferred directly into a TFSA instead of an RRSP?
Your early service payout offer can only be rolled into a personal RRSP. You could invest the money into a tax-free savings account, but investments into a tax-free savings account happen after income tax is already deducted. So you would receive the offer with income tax already deducted and then contribute to a TFSA.
Most teachers max out their CPP and EI around August, September. Does taking this award mean you pay more CPP and EI, or do you simply max out earlier?
CPP and EI will be deducted from this early service payout offer. You will not pay more CPP and EI for the year because they both have maximums. Most teachers have already contributed enough to CPP and EI with their regular salary by August or September. However, because you're receiving this income as an employment income, it will potentially mean that you finish contributing to CPP and EI earlier in the year.
Is there a timeline you have to wait before you can start withdrawing this RSP money?
There's no timeline to wait before you can start withdrawing money from your RSP if you decide to roll your early service payout offer into an RSP. However, as soon as you start withdrawing money from your RSP, it does become taxable income.
For your child tax benefit, how high can your income go before you lose your benefit?
The child tax benefit that you receive is based on your family income and the number of children that you have. All that we really want to say about that is if you currently are receiving the child tax benefit, this early service payout offer, if it's received, especially if it's received as cash, may affect that benefit.
What are the implications if you are currently in bankruptcy or recently released? Does your service award have to go to your creditors?
If you are a bankrupt or recently released from bankruptcy, you really should refer your questions to your bankruptcy agent for information on how to deal with your service award.
What if the government is defeated in court and the service awards are reinstated, or if a new service award is negotiated in a future contract? What happens to those who took it early?
If the court challenge by the NSTU is successful, or if in the future a new service award is negotiated in a future contract, it will be up to your Nova Scotia Teachers Union to provide you with direction as to what that means, and they will be responsible for negotiating any rules around the potential impacts to the service award. So Dale and I hope this information has been useful. We certainly would encourage you to call us, either Dale Rood, myself, Steve Richard, or Tim McHackern at Teachers Plus Credit Union for individual questions or further information. Also, if you decide to choose to take it in cash or in an RRSP, we would be happy to talk to you about the products available at Teachers Plus and all the options that we have available to you. Thank you very much for taking the time to listen to our presentation, and we hope to talk to you again in the near future.